everybody. Hello. It should be. All right, how about now? There we go. All right. Hey, all right. Does everybody see the opening screen here live? We're actually not on the board floor, but how's everybody doing? All right. Welcome, everybody. Thank you for having me today. I'm Mike Shorr. I am filling in for my good friend and our CEO, Scott Bauer. I will be doing Market Minds today, and we are going to talk about implied volatility and IVR. So please, if you like these, please subscribe and smash that like button. That would be awesome if you did that. All right. So, implied volatility. What is implied volatility? Let me see. You guys see this Word document here? Yeah, you do. Okay, so implied volatility, I'm just going to call it IV from now, is the yearly standardized move for a given security. So, for example, if stock XYZ is trading for $100 and has an implied volatility yearly of, let's just say, 30%. This means that over the course of a year, approximately 68% of the time, the stock will be between $70 and $130. Okay? About 68% of the time. That is the statistical measure that we use, which is standard deviation. So that would be equivalent to 100 plus or minus 30%. All right? Two standard deviations, which you see, I have my drawing tool up, I thought, so two standard deviations here and here, that would equal I'll just say above or below the 2SD, I guess metric, be above or below about 95% of the time. And 3SD, same stuff as above, but about 98% of the time. Okay? Just based on Gaussian math. Everybody with me on that? And so it's a statistical measure that allows us to deal in the realm of the probabilities of what is probable and not necessarily possible, right? Stock XYZ could go from 100 to 500 or go from 100 to 0. But statistically, this is what we're looking at. Hey, Jake. Hey, Kevin. Hey, Aladdin. Hey, Gene and Robert and Kevin and Gus and Herbert and Harris and Eric and Kevin again. If I missed anybody, I apologize. So it gives us a reasonable expectation of what the market is expecting. Again, we live in the realm of probabilities, not possibilities. And so when we're setting up our spreads, we're going to use metrics like the standard deviation to say, okay, what is reasonable to expect? Bullish, bearish. Now, does implied volatility levels tell us anything about the direction? It doesn't. It doesn't tell us anything about direction. We are assuming a normal Gaussian or bell curve here. But if we go down 1SD, if we go up to 1SD, it's reasonable to think that way. Now, people will say, well, when implied volatility goes up, usually that's when a stock is going down because of the nature of the way that stocks move. Down elevator, up escalator. But we don't make our assumptions based on that. Yes, people panic to the downside. Okay, so when you look at high implied volatility, not only, and I might have to bring up so not only does the curve increase in amplitude, oh man, pulling out big words here, but it also widens out the expected range. So as we see here, when we have high implied volatility, we have almost a higher but almost more shallow implied volatility curve. Because with the high implied volatility comes along with the fact that we might move more than what would be normal. And then we see as implied volatility comes down, not only does implied volatility come down, but also the shape of the curve becomes, this might not be a mathematical term, but it becomes more skinny. Because the low implied volatility implies that we're going to stay in a range as opposed to when we are getting out into high implied volatility environments. So it's funny because I'm sitting here talking with my hands as I normally do, but as implied volatility goes up, not only does the middle of the curve go up, but also that curve widens out because it takes into consideration that there is more tail risk than there was before. And then, of course, the converse is true as we trend down into mid-level implied volatility and then down into low implied volatility. Does that make sense, everybody? I'm not trying to confuse anybody. But higher implied volatilities means a flatter and wider curve. Low implied volatility means a more narrow or more skinny curve. Okay, good. Okay, so now, anybody have any questions on implied volatility before I move on to IVR? Just want to make sure before I move on. Okay, so I'm not seeing any questions. So now we always talk about buying low and selling high in implied volatility, just like anything else. I always say it's like a house, it's like a loaf of bread, it's like anything else. You want to buy low, sell high. But what is high implied volatility and what is low implied volatility? Is 50% high implied volatility? Or is 25% low implied volatility? Exactly, Kevin. Depends. Because there are stocks, and I think that many of you in here have traded them. Some stocks move more than others. Right? Something like Tesla that can have easily a 5% intraday range, that's going to have a higher implied volatility than something like, let's say, I'm not picking on them or anything, but like General Mills or, a big bank. And so now we have to look at what is reasonable when we are talking about high implied volatility versus low implied volatility. And so we can't compare oranges to apples. Look at what implied volatility was in Circle. Anybody was in Scott and STO's Circle trade? When we put that trade on, that implied volatility was about 215%. And now that we see that coming down, now 215%, is that high or is that low? Well, it depends on the equity. And so what implied volatility rank does is it takes the last closing implied volatility on the daily chart of historical data. And then it lines up all of those implied volatilities in a row, highest to lowest. Doesn't matter what it is. If it's Circle, if it's General Mills, if it's General Electric, if it's NVIDIA, it lines them up from top to bottom. And then we can say, okay, now we can make an assertion of where implied volatility is in this exact equity compared to what it's done over the last 5 years. So, for example, I'm just going to bring you guys see this, right? So if we just, in Thinkorswim, if we go to our trade thing, let's just go to circle. Let's see where it is. Get rid of that. All right, so now, oh, well, we don't have 52 weeks. Let's just go to, because circle hasn't been. So if we go, when we look at, if we go to trade and we go to NVIDIA, and then we look at the bottom here, we can see that the implied volatility of NVIDIA is 7%. What does that mean? The IVR, and it's actually, for the math nerds out there, it's actually a percentile. It's not a rank. Small nuance there. I know about it. Whatever it is, the implied volatility has only been, let me highlight this here. The implied volatility right now is, the IVR is 7%. That means 93% of the time over the last 52 weeks. Has it been lower than 7%? 93% means that, or excuse me, 93% would be that it's been higher than that. So what does that tell you? And Barry just asked, what's the difference between current IV percentile and implied volatility? So you would say right now that current implied volatility has only been lower over the last 52 weeks, 7% of the time. That means 93% of the time, implied volatility has been higher. Right. So what David said, it's not really volatile for this stock. This stock, if anything, if you are considering any sort of trade, you want to do this from the long side of options. Selling an iron condor here, it may work. Statistically, it shouldn't. So whatever you are going to do, at the very least, don't be selling Vega here. Don't be selling implied volatility. Either have no opinion, or you have to go from the long side. Because if you get burned on a trade like this and you sold implied volatility down at a 7 IVR, you shouldn't be surprised when you lost your butt. Because you're playing against the odds. It could be a no trade. Happens all the time. Lots of times we look at things, it's like, man, this is not looking all that great. Sorry, I just made a big square for no reason. Let me get rid of that. Get that out of the way. Okay, so for example, I mean, we talked about that. And we percentile, same metric. How many times, and that's why I said there is a small nuance between IV rank and IV percentile. Quite frankly, I would say that you're kind of splitting hairs. Either you have to determine, is implied volatility high or low. IVR of 7, implied volatility is low. So this is making me think of calendar spreads, diagonal spreads, or straight vertical put or call in something like NVIDIA. I don't want to be selling options into NVIDIA when implied volatility has only been lower than this 7% of the time over the last 52 weeks. That's okay. You move on to something else. I wasn't saying to do that. All right, hang on one second here. I guess Mike is the word of the day, Shorr? Okay. All right, word of the day is Shorr. Get your names out there. You will be on the wheel. I have a very short last name. It's amazing how many people spell it wrong. And I'm not Shorepsshorr. Dogs do like me. Babies and dogs. All right. So what questions do we have? Ooh, man, my voice just cracked. What questions do we have for me before we get into the wheel and all that other stuff? Jersey Shore loves me. I think Shore, that's the Germanic way of spelling it. Schorr, Pschorr, doesn't it's very simple. Shorr. All right, so what kind of questions can I ask of you? That's what IVR is. Does anybody have a stock that they're looking at that they would like to talk about the IVR of that? Do I use a moving average? No, I don't use a moving average. I just do it over a 52-week period. So what percentage of IV would I consider a sell of premium in NVIDIA? Well, certainly not 7. Remember, so if something has a 0 IVR, that means over the last 52 weeks, we have not been lower than this level. If something has 100 IVR, that means that we haven't been higher than this implied volatility level over the last 52 weeks. So 50% would be what would be considered fair. Whatever it is, anything below 50 and with NVIDIA's propensity to move pretty darn quickly, whenever the market, that means up or down, whatever it is, I'm not selling implied volatility here. So something like coin, there was a couple people that put in coin here. So coin has an IVR. Still with this chart, look at what coin looks like on a, that's not the one. There it is. If we look at coin, it's breaking out. It's about to go crazy. Look at where it stopped. Look at where it stopped, right at that old highs. This is on a weekly. Came down right from there. But whatever it is that I would be doing in coin, I wouldn't be selling implied volatility when 70% of the time over the last 52 weeks, implied volatility has been higher. And how does implied volatility affect calendar spreads on iron condor or iron condors? Well, in the calendar spread, you're going to be net long implied volatility because you are longer, or I'm sorry, you are long a call or put, an option that has a longer expiration date than the one that you've sold. That's the definition of a calendar spread. So you are net long Vega. So when you are looking at something with a relatively or maybe very low IVR, first thing that jumps into my mind is calendar spread, diagonal spread, or straight vertical spread. Because I want to be buying implied volatility when those relative implied volatility levels are low. Conversely, when you're talking about an iron condor, if I'm thinking about selling an iron condor, I'm selling something that has a relatively low IVR over the last 52 weeks. So really, and for those of you in OV, last month, last 6 weeks, you were doing a lot of condor, credit condor type of spreads. We did a couple too, but not as many as you did. Why? Because implied volatility was a lot higher. Look at what the VIX curve looks like right now. The VIX went from 60 right back where to it was at 20. Really, we're trading 1937 right now in the front month VIX, or actually, we should be looking at futures on the VIX, but we see that they spiked up all the way to 40, 44 plus. That's when the Iran Israel stuff went down. Everybody got freaked out. Now we're right back, and we are actually below the 200-day moving average. The market's not worried about the downside right now. Could that change? Of course it can. Am I a seller of VIX right now? Is anybody a seller of VIX right now? That's a good question. Nobody wants to answer it. I'm not going to sell it either. That doesn't mean I'm going to buy it. Remember, we can just do nothing. But again, let's look at where the VIX is again here. Can I do VX here? Will it give it to me? All right. Current IV percentile is 13%. That means 87% of the time, implied volatility has been higher. 13% of the time it's been lower. Can it go lower? Yep. Do I want to bet 80? Does anybody want to take a bet on 87, 13 odds? I don't. There's the answer. So if you pointed a gun to my head, and please do not, that's kind of rude. I'm a buyer of VIX here. We're almost at the 50-day moving average, and we see that most likely we're probably, if we're wrong, probably stop ourselves out at 17, or we get something crazy where we get the VIX above 40. I don't know what's going to happen in the future. You don't either. But what I do know is where it's been, and it looks like things have settled down. The stock market hasn't really reacted. We don't see any crazy moves in other, we've seen some moves in other sectors, but not crazy. But if they want to try and sell this thing down a little bit more, probably a good idea to buy some VIX. Do we think that everything is just fine and dandy in the world? Israel, Iran, trade, tariffs, those are kind of the same thing. Anything else you could throw in the mix? I'm not a seller of VIX. Thank you, Mike. Everybody, the wheel is closed. Mike will give me the window here in a second. But that's where you have to look at. Don't think about what you think is going to happen or what you hope is going to happen. I always say trade what's in front of you. Is something out of line? VIX seems to be lower fare right now. Stock seems, I mean, quite frankly, um, I'm I'm surprised that we're pushing these highs as we are. And that's why we have, we do have a protective position here in Qs. It's not doing all that well right now, but we need that protection and we've killed it on other things. Some things are priced in the VIX already. Some things like what? Looking into the future, Kevin? I don't know what's going to happen. I'm just saying I'm not a seller of VIX. You want to get up into the 34 area, 30-40 area in the futures, then I'll start selling VIX. Everything is priced in the VIX, not some things. Everything is priced in the VIX. Everything is priced in the markets. What we know now. Can the world drastically change in a day or two? You're darn right it can. There's a lot of things. Everybody's completely forgot about trade wars just because of all the chaos. You can't keep up with it. And the market seems to be okay with that right now. And we've made most of our money today on calls. That's why I say trade what's in front of you, not what you think is priced in, not what you think the market's going to do. Price into what the market is doing and make your trade off of that. And allow yourself that freedom. You don't have to see into the future. You have to react to when things get out of line. That's it. That's all about trading. Hope and pray is not a trading plan. Just because I know it's going down or I know it's going up. If you do, explain to me how you know these things. I don't know these things. I know when things get a little bit out of line. Or sometimes a lot of bit out of line. John, IV percentile and HV percentile are two different things. HV percentile is the deviation away from a moving average in percentage terms over a course of a period of time. It's saying this is what has been realized. Implied volatility is what the market expects going forward. HV percentile is based on data that we already have. Implied volatility is what the market is thinking going forward. So something could be moving very, very little going into, let's say, an earnings report or whatever it is. So its HV percentile is going to be very low. But if we have something like a big number coming out, FOMC, unemployment, PCE, or Fed, well, the market is expecting most likely is going to be, we are going to be moving more than we're typically used to. So HV, historical volatility, is a measure of the realized volatility around some mean that you define. Implied volatility would be the market's expectation going forward. Good question. All right, let me get this this window out here. Hang on here. All right, bringing it in. Lots of names on the wheel. Thank you, thank you, thank you. All right, here we go. Well, who's it going to be? Is it Thomas? Is it Steve? Thomas Swift. So fantastic. Nice work there. Close that. All right. Any other set hard stops, live on the edge? Yep. All right. Is there any questions before we close this up here? I want to appreciate everybody here. And Thomas, please email us at prosperswag@prospertrading.com. We'll get you set up. All right. Well, all right. We will get back in STO, back to trading. Good day so far. Tight, very tight. We've had to be quite selective, but thank you, everybody, for coming by. I appreciate it. Don't forget to smash that button and subscribe to us. It helps us out a lot on this side. Everybody have a great day. Thank you for being here, and I will see you back in STO or the other rooms.